Everyone's screaming bubble, but what if the data proves otherwise? The media has guessed daily to address the AI bubble, the gold bubble, the stock market bubble, and there are hundreds of YouTube videos out there about the everything bubble. The market is going to crash. Time to sell. In today's episode, I'm showing you exactly why we're not in an everything bubble using 5 critical indicators that most people are unaware of. 2 of them, Warren Buffett uses to determine whether the market is overvalued or undervalued. And most investors have never heard of these calculations, and I'm going to show you exactly how to use them in less than 6 minutes. But before we get into it, this is Brian. I've been a financial advisor for over 25 years. I'm an author and certified life and health coach. And my goal is to help you save smarter, invest better, and keep more. In this episode, you're going to learn 3 wealth decision principles to remember to make you smarter with money. And these separate bubble hysteria from market reality. Plus, you're going to get an action plan, one that helps you make better wealth decisions starting today. 2 weeks ago, my client Jason called me. He said, Brian, I want to sell everything. The Magnificent 7 stocks, all my ETFs and funds, even my bond portfolio. I asked one question. Is your reason because of facts or fear? He thought high prices meant a bubble, and everyone is saying we're in a bubble. So here's what you need to understand. A bubble needs 2 things: extreme prices and reckless behavior. High valuations alone aren't enough. You need speculation, excessive borrowing, and blind faith. In 2000 and 2007, margin debt exploded above 55% of market cap. Investors borrowed heavily to buy stocks. When prices started to fall, forced selling led to an even greater crash than would otherwise. So where are margin debt levels right now? We're going to answer that coming up in just a minute. But here's what's happening. Markets feel expensive. Your friends are saying they're thinking of selling everything. The media screams bubble or the coming crash almost daily. But 5 key metrics tell a different story. So let's start off with the Magnificent 7 reality and the profitability picture. Let's start with the hard numbers because this destroys the bubble narrative almost immediately. The Magnificent 7 today, their net profit margins are averaging 25.8%. The S&P 500 overall about 13.4%. Compare that to the dot-com leaders in 2000, -5% or break even. They were burning cash. Today's leaders are generating it. Here's some perspective from the past. The price to sales multiples during the dot-com peak hit 49 times. Companies with 0 revenue traded like gold mines. Today's AI mega caps, 4 to 7 times sales. That's not even in the same universe. Now, there's multiple exceptions to this, Palantir being one of them. It's trading at a level I think I've never seen a company trade at. And it's probably the reason many are shorting this stock. But because they have virtually no competition and really high profit margins, the company probably has a bright future, but is also probably a little ahead of itself. Most of these mega cap stocks are not just selling products. They're building infrastructure, data centers, AI chips, cloud computing, real demand, real customers, real money. Think about it for a second. Would you rather own a company losing money at 49 times sales or one making 26% profit at 7 times sales? Let me know in the comments because that's the choice between 2000 and today. So this leads me to wealth decision principle number 1. Profits protect prices. Revenue alone does not. Write that down. The dot-com bubble had revenue stories. Today's market has profit statements. Know the difference. It could save you from making a bad decision based upon headlines. Coming up, I'm going to reveal the margin debt number that changes everything. I'll show you why gold isn't a bubble despite record prices. Plus, Warren Buffett's 2 famous indicators and why these indicators matter more than price alone. So let's talk about the margin debt, the speculation indicator. This is the indicator most people ignore, but it's arguably the most important. Margin debt measures how much investors are borrowing to buy stocks. When everyone's borrowing heavily, that's speculation, that's greed, that's bubble behavior. According to Investors Business Daily, the current margin debt sits at 38% of market capitalization. But here's the number that matters. History shows bubbles form when margin debt levels exceed 55%. In March of 2000, it hit 55%. The market crashed. In July of 2007, it reached 57%. The financial crisis followed. The pattern is pretty clear. At 38%, we're elevated from historical norms, but we're nowhere near the danger territory. We've got about 17 percentage points of cushion before hitting bubble levels. So what does this mean? Think about what this tells you. Investors aren't mortgaging their homes to buy stocks. They're not borrowing recklessly on margin yet. The speculation isn't there yet. Are some people over leveraged? Sure, but it's not systematic yet. So quick question for you. Do you use margin in your brokerage account? Reply to my pinned comment. I'm curious how many people understand the risks because most don't. Now let's talk about the Buffett Indicator, Warren Buffett's favorite market valuation metric, total stock market capitalization divided by GDP. The current reading is 203%, higher than 2000's peak of 146%, which sounds terrifying, right? But here's what separates smart investors from scared ones: context. Interest rates act like gravity on asset valuation. When rates are lower, higher valuations make sense. When rates are high, valuations should compress. In 2000, the 10-year Treasury yielded 6.5%. Today, about 4.4%. That's a 32% difference in the discount rate. Lower rates mathematically justify higher multiples. The calculation matters. So let me walk you through the exact math. Step one, take the current 10-year Treasury yield. As of today, it's approximately 4.4%. Step two, divide 100 by this yield. That's 100 divided by 4.4, which equals 22.7. This number represents the theoretical P/E ratio stocks should trade based upon risk-free rates. Now compare this to the S&P 500's current P/E ratio. The S&P 500 has a current P/E of about 27. The theoretical fair value based upon interest rates is 22.7 times. Stocks are actually slightly overvalued considering its current PE, but in line with the forward PE of 22.3. In 2000, the 10-year yield was 6.5%. The theoretical PE was 15.4, but stocks traded at 44 times earnings. That was a bubble. So let's talk about that critical context. Number one, corporate America is more profitable per dollar of GDP than ever. Profit margins have expanded dramatically. And second, global revenues. S&P 500 companies earn 40% of revenue internationally. GDP only measures domestic output. And third, AI infrastructure spending. Companies are investing hundreds of billions in data centers, chips, computing power. This spending shows up in market cap and GDP immediately, but revenue and productivity gains, those come in 2 to 3 years. This creates a temporary distortion that will tend to normalize over time. So this leads me to wealth decision principle number 2. Interest rates set the table. Earnings serve the meal. Lower rates support higher valuations, but only if earnings follow through. Right now, both factors align. That's not a bubble. That's a functioning market. Now let's address the market concentration because this is where things get pretty interesting. You've probably heard that the Magnificent Seven represent a very large part of the S&P 500. The Magnificent Seven now represent about 36% of the S&P 500 market cap. During the dot-com peak, the top 7 companies represented only 19%, so concentration is nearly double. Michael Burry noticed this. He's betting 80% of his portfolio on put options against NVIDIA and Palantir. Michael Burry was famous for betting against the mortgage market, and he won big. If you haven't seen the movie, The Big Short, I'd highly recommend watching it. But one thing to keep in mind about Michael Burry, he was right in 2008, but he hasn't really been right since. Here's what changes everything. In 2000, the top 7 were overvalued and unprofitable. Today's top 7, they're generating billions in free cash flow, net margins of 25+%, and they're buying back their own stock. And they're also funding AI research. Concentration of profitable companies is different than concentration of unprofitable ones. The investment is real. The returns just haven't completely materialized yet. Give it time. This doesn't mean these stocks won't correct along the way. They've already been correcting these past couple weeks, but these companies have a bright future ahead of them. But the valuation reality is forward price to earnings for AI mega caps sits at about 27 to 30 times. Dot-com leaders traded at 50 to 60 times, and those were imaginary earnings. Today, earnings are real, cash is real, the difference matters. So now let's talk about why gold isn't bubbling. Here's the difference from a bubble. Retail investors aren't flooding into gold. Most people don't own any. Gold ETF holdings are actually declining in some markets. The buying is institutional and measured, long-term and strategic. In a gold bubble, you'd see retail panic buying, people melting down jewelry to buy coins, gold dealer ads, every other ad on CNBC. We're nowhere near that. Gold is expensive, but it's not completely irrational right now. Now let's talk about real estate. Prices are high. Everyone knows this, but here's the critical difference from 2007. Supply is historically low. Housing inventory is at 40-year lows. Demand is driven by demographics. Millennials are in peak home buying years. In 2007, supply was surging. Anyone could get a mortgage. Ninja loans, no income, no job, no assets. Speculation was rampant. Today, lending standards are tight. Most buyers have documented income and 20% down payments. So here's the fundamental difference. High prices with low supply and real demand isn't a bubble. It's a shortage. Could prices fall if rates rise further? Yes. But we're not seeing speculative excess. We're seeing fundamental supply and demand imbalance. Gold and real estate are expensive, but expensive doesn't equal bubble, at least not yet. So boom or bust, what stage are we in? Let's talk a little bit about bull market cycles. Here's the question everyone wants answered. Which stage of the bull market are we in? Because every bull market has 4 stages: skepticism, optimism, euphoria, and denial. Stage 1 is skepticism. Markets recover from a bottom. Nobody believes it. Everyone expects another crash. Valuations are cheap. This was 2020 to mid-2021. Fear dominated. Investors sat in cash, and those who bought early made a ton of money. Stage 2 is optimism. Markets climb steadily. Earnings improve. Economic data strengthens. Investors start believing the rally is real. Valuations move from cheap to fair, and this was late 2021 to 2023. Stage 3 is euphoria. This is where bubbles form. Everyone's buying. Your Uber driver talks about options trading. Margin debt exceeds 55%. Valuations don't matter anymore. FOMO dominates every decision. But here's the question. Are we in euphoria? I don't think so. Yes, AI stocks are hot. Yes, gold has hit record highs. But margin debt is only 38%, and financial media still questions sustainability. People are still worried. That's not euphoria. That's late stage optimism. When nobody worries, that's euphoria. Right now, there's plenty of people that are worrying, including you and I, if you're watching this video. So now let's talk about what to watch for. What are the warning signs for stocks? What signals moving from optimism to euphoria? For stocks, margin debt crosses 55%. The interest rate indicator shows stocks trading at 50% above fair value. Profit margins compress while prices keep rising. IPOs of unprofitable companies surge almost on a weekly basis. For gold, retail panic buying. Gold dealers advertising everywhere. ETF inflows surge. Jewelry demand spikes irrationally. For real estate, lending standards loosen dramatically, no doc loans return, everyone's flipping houses, supply surges while prices keep climbing. Right now, none of these are present at bubble levels. Monitor them quarterly, not daily. Trends matter more than snapshots. And right now, the trend shows expensive markets with really solid fundamentals. So this leads me to wealth decision principle number 3. Bull markets climb a wall of worry. Bubbles climb a wall of greed. If you're worried about valuations, that's actually healthy. It means we're not in euphoria yet. When nobody worries anymore, that's when you should panic. Right now, plenty of people are worried. That's a good sign. Use that worry to stay disciplined. All right, let's make this practical. Here's your action plan to implement this week. Here's my 5-minute challenge. Step 1, calculate the interest rate indicator. Go to treasury.gov, find the 10-year yield, divide 100 by that number. Compare to the S&P 500 P/E ratio on any financial site. If the P is within 20% of the calculated number, stock valuations are reasonable. Step 2, the asset class checkup. Review your portfolio allocation. What percentage is in stocks, gold, real estate investment trusts? If you're over 70% in any single asset class, you're concentrated. Not necessarily wrong, but you should know your exposure. Step 3, the margin debt bookmark. Save finra.org. Check margin debt quarterly. When it crosses 50%, start getting a little more defensive with your investments. At 55%, significantly reduce your risk. This one indicator has predicted a lot of the market crashes in modern history. And real quick, if you are on margin, if you're using more than 20 or 30% of your portfolio to buy more stocks, and you're heavily weighted in technology, it's time for a reality check. These companies are changing the world. They have profit margins that I haven't seen in a long time. But it's time to start thinking about reducing your exposure to certain parts of the market, including the U.S. In step 4, the bubble checklist. Create a simple document. List the warning signs for each asset class. Check it quarterly. Are you seeing retail panic buying? Are lending standards loosening? Is everyone around you getting rich? If all 3 are yes, we're likely headed to euphoria. And step 5, if all of your money is in the U.S., consider adding international and emerging markets where valuations are much more attractive. If you haven't seen my episode about Goldman Sachs projections for the next 10 years, click the link above to listen to that episode. This is information you need to hear because Goldman's projections of the U.S. versus international has a big gap. And you're going to want to make sure that you get the best returns for your investment portfolio over the next 5 to 10 years. So let's bring this all together. We're not in an everything bubble yet. Stocks have strong earnings at 25.8% margins. Margin debt is 38%, not 55%. Interest rates justify valuations based upon next year's earnings. Gold buying is institutional, not speculative. And real estate is a supply shortage, not speculation. We're likely in late-stage optimism, not euphoria. The worry you feel, that's actually a good sign. Well, I hope this gave you a clear framework for evaluating stocks, gold, and real estate. Comment which asset class you're most concerned about. Subscribe for weekly episodes. Share with someone who's panicking or telling you they're selling everything. Once again, this is Brian, the Wealth Decisions Guy, and I hope to see you next week.